Okay, everybody. Conan is under the weather this week, and so I'm going to be recording the podcast on my own. I'm sure he'll be back with us next week, but we have a lot to get to, so let's get on it. TSP Weekly Podcast, 8 March 2026. We're going to take a look at some of the weekly economic highlights, a Facebook group comment. We'll take a look at what actually drives the market, and then the big news of the week certainly was the kickoff of the Iran war last weekend. And we'll take a look at oil, the dollar, and the I fund. It was a rough week for the I fund. And we'll take a look at, in general, the TSP fund direction. So to start off on a positive note, right, the ISM manufacturing is one half of the economy. Services is the other half. And so manufacturing PMI slipped to 52.4 in February from 52.6. So it was down a little bit, but as long as it's above 50, then the manufacturing side of the economy is expanding, right? And that's a good thing. The reading signaled the second consecutive month of expansion in the manufacturing sector, although it was at a little bit slower pace. So this is what it looked like, right? This is February's manufacturing PMI, a little bit lower than January, but way above the average highs over the past 3 years. So that's a really positive for the economy, right? The second half is the services side of the economy. And that climbed to 56.1 in February from 53.8 in January. And it also beat the expectations, which was 53.5. And again, the big number is 50. As long as it's above that 50 number, then the services side of the economy is expanding. And growth was driven by a sharp pickup in business activity. So lots of good momentum on both sides of the economy. So this was a big month. Getting up to 56 was a big month for the services side. So the economy is doing well, right? But the economy and the stock market are two different things. As we've seen, the economy has been lagging, right? The services side has held up pretty well. 50 is really the number to be above. And the services side has done pretty well over the past 3 years, but the manufacturing side is just now catching up. So the economy is actually doing better. Housing, right? The average contract rate on a 30-year fixed mortgage was unchanged, but it's at 6.09, right? That's down quite a bit. And mortgage applications were way up, right? They were up 11% versus last week. So after peaking, here in 2023, the long-term trend of mortgage rates has been down, but even the short-term trend in rates is way down from the middle, fourth quarter or so of 25 into the first quarter of 26. And we have more people looking to buy houses. So that's good for housing. So the economy is doing better for sure. And interest rates up until this week are coming down, which is good for housing. So those are the positives. Unemployment on Friday, right? Unemployment came out on Friday, rose to 4.4% in February versus 4.3% in January, and a little bit above expectations. The broader U6 unemployment rate includes discouraged and underemployed workers, right? It's a little bit of a broader index, and it declined to 7.9 from 8.1, which is actually a good thing. But what we're worried about is, in general, the overall, again, a 3-year trend in unemployment is up. We had a short-term trend in unemployment coming down. So that was pretty optimistic over the past, several months since November, right? We didn't have a number in October because of the government shutdown. But then from November, December, January, the trend was down, which was a good thing, right? Unemployment was coming back down. Ticked back up again this month. If we can keep, sustain that kind of level at 4.3, 4.4, we might be able to stave off a recession here for a little while longer. But a rise in unemployment, if it continues to the upside, definitely not a good thing, even if both sides of the economy are doing better. Okay, so we had a lot of interesting comments in the Facebook group this week. Obviously, the market was way down, particularly the I fund, and there's a lot more talk now, of course, about the G fund. And so one post that came up on Tuesday should I put everything in the G fund, right? So this posted on Tuesday at about 12:30 in the afternoon East Coast time, and we had well over 150 comments. I'm sure we've got a couple hundred comments in there at this point. But the comments ranged, right? So these are kind of the general theme of what the comments were. So someone says, I did, we'll sleep better for the next few weeks. Other people say, nope, leave it alone, it'll come back, right? Some look at these as buying opportunities. A buying opportunity is an interesting idea because to buy the C fund when it's lower in price, you have to reallocate from the G fund into the C fund when the price of the C fund is lower. So you would have already had to be in the G fund to take advantage of the decline in price that we had in the C fund this week if you were going to buy back into it. That's on your core account, right? You can always dollar cost average into the stock funds, which arguably is a reasonable methodology, but you're doing that with new money. So, however much you're contributing every payday. And other people are saying, nope, ride the wave. It's only temporary. Other people are saying, too late. You should have done it last week. We're going to take a look at a chart on that in a second. And then turn off the news. Turn off the news, absolutely, right? The market doesn't, it's not that it doesn't respond to the news. It's not that the news doesn't affect the market. It's just that those are not the big things that drive the market. We're going to get to that in a second. What I didn't see anywhere in these comments is, people thinking through the idea of using technical analysis to determine whether or not they should be in the G fund, right? What is the market risk as opposed to fear and anxiety about what's happening in Iran right now? And so we put up this chart, this particular chart we put up in a members update earlier this week, but we put up this chart several times over the past month or so in the podcast. And so what this is a daily chart of the S&P 500, right? So each one of these ticks is one day of price movement. And we're going back to, this is the high before COVID. So all I did was take the bottom from COVID and connect the bottoms. Okay, so you get 4 bottom points, which gives you a really strong bottom channel line. And then I took this line as a parallel and brought it up to this high. Okay, so that gives us our parallel channel, right? So if you extend that parallel channel, this was the peak in October. And by January, we were riding this line. Okay, we have not been able to push above that line since October. And so what that's saying is this line is resistance for price. And if the history of this cycle continues, the next direction for the S&P 500 is down. It doesn't mean it has to happen that way. But if you look at the chart, obviously the cycle of the chart is that the next direction of the S&P is down. So until this upper channel line is violated, if we get a close up here, above 7,000, then we're outside of this channel. And now this upper channel line becomes support and price can continue higher. But until we get above that channel line, the channel needs to be respected. Okay, there's a lot of resistance there. The other part of this is Fibonacci extension levels that we talk about all the time. We did the Fibonacci extension from the top before COVID to the bottom of COVID, right? So the length of this line times 4 gets you up to this price level. Then we did the same thing from the top in 2022 to the bottom in 2022, right? So the length of this line times 2.618 gets you to that level, right? And these are all Fibonacci extension levels. Then we did the same thing from the top in 2025 to the April low, right? So 1.618 of this pullback gets us to this level. So all 3 of these Fibonacci levels are overlapping at the same time where price is at that upper channel line. So what that's telling us is there's a lot of resistance for price to move higher. It could move higher, but there's a lot of resistance at that 7,000 level, right? Really just below it, but right at that 7,000 level. And now we're seeing the market starting to roll over. So this is an analysis of price movement. It doesn't take into account your personal circumstances and risk tolerance. So if you're looking at this saying that's fine, I think the market's going to turn around from here and go up. That's a possibility. It's also possible that the history of the cycle continues and the market goes down. But this is the analysis of what's happening in price. And so when people back here say, it's too late, you should have done it last week. Well, last week we didn't really have a rollover, right? The risk now is a lot higher than it was last week because the market is clearly rolling over versus what it was doing last week. And we'll see that more on the weekly chart here at the end. My favorite one here is consumer staples versus the S&P 500. So XLP is the consumer staples ETF. Consumer staples are things like things that people need versus what they want, right? Toilet paper and Coca-Cola and cigarettes. Those are consumer staples as opposed to Tesla and companies that people want. So when big money, so investment companies, big money, they don't have the luxury of going to the G fund. They need to be invested, and so when risk is high, they invest in things that people need as opposed to things that people want, and that drives the ratio of consumer staples versus the S&P 500 higher. And when that ratio goes higher, the price of the S&P 500 in blue goes down. And it's the reverse, right? When people start buying more or less consumer staples versus the S&P, then the ratio goes down and the S&P 500 index goes up. So we talked about this last week. We've had a big uptick in the ratio, but we didn't really have any downward movement in the S&P 500. And so what it's telling us is there's a lot of reallocating by big smart money, right? Big money into consumer staples, and it's being sold to retail investors, which is why the S&P hadn't rolled over at least until Friday. So again, it's a market analysis, and you look at this and decide whether or not the risk of remaining in the S&P 500, the stock funds up here, is worth the potential return. Okay, so what actually drives the market, right? The market isn't driven by headlines. It's driven by capital movement. Okay, and so it could also be called sector rotation. So what happens is big money is in sectors that are rising. When those sectors get overvalued, they sell those sectors and buy undervalued sectors. So in this chart, you got the tech software sector, which has been driving the S&P 500 higher at least since 2023. It peaked in October 25 and is down 35% as of about the 24th of February. So even as the tech software sector is in a bear market, right, down 35%, the S&P 500 has remained flat. So how can that happen? It means other sectors within the S&P 500 are taking up the slack right now. And a couple of those are energy, right? Energy had been flat since it peaked in 2022, right? Hasn't really moved at all to the upside over the past couple of years, where the S&P 500 was moving much higher. So that means energy is undervalued relative to the S&P 500, certainly relative to tech software. And so once tech software started to roll over, big money reallocates out of tech software and into things like energy, and so energy goes up. And so energy it's not as big a part of the S&P 500 as tech, but when energy goes up, it helps to offset the losses in tech. And so that's sort of part of the reason why tech can come down and the S&P 500 can remain flat, right? Another example of that is consumer staples, like we just talked about. Consumer staples, again, peaked back here in 2022. It's been basically flat, and it broke out on a fear trade, right? Consumer staples are way undervalued, and investors are starting to reallocate into consumer staples and out of things like tech. So what does that mean overall right now. We had tech that came down to 76. It hit that 76 level 3 times in the past couple of years, right? And found support there. So that tech sector, tech software, found support again at that 76 level and popped over the last 2 weeks. So if this is an actual bottom in tech software, and this chart continues higher, that's really bullish for the S&P 500. That could mean we're at a bottom here, right? So it's going to be, if you're bullish on this market right now, you definitely want to see tech software continue to the upside. If it rolls over and closes below 76, it's likely that the S&P goes significantly lower. It's certainly possible that, tech software, if it continues higher and consumer staples starts to roll over, then yeah, the S&P could have a really short correction. The correction could have ended on Friday. We don't know. But if tech continues higher, that's really bullish for the S&P. If it rolls over and continues lower, it's a problem. Okay, oil, the dollar, and the I fund. So this is a weekly chart of West Texas Intermediate crude oil. And so it bottomed here under $10 a share and at the bottom from COVID, and then rallied all the way up to $26 a share at the high in 2022. Okay. This green candle right here was the Russian invasion of Ukraine. And that actually marked just about the peak in oil for that cycle. The difference right now is that once oil peaked at 126, it declined to just above the 0.618 retracement level, Fibonacci retracement level. So the 0.618 is the most likely place where price falls and then finds support. And in this case, it got just above that 0.618 retracement level, hit 55 several times, right, in 2025 and 2026, and then recovered, which is fine because we have this downsloping trend line. So from this peak in 2023, oil peaked here and had been in a decline. So this rally was fine in oil until we got the gap up this week and about almost a 30% move to the upside in oil in 1 week. And so while the spike in oil back here was coming, after this big rally in 2022, but now it's coming after a 0.618 retracement and finding support at 55. So what I'm saying is this is more likely than not the beginning of a move higher in oil, not the end of a move higher. And if that turns out to be the case, it's going to be very difficult for stock prices to continue higher, right? And so when oil goes up, countries have to figure out how to buy higher priced oil, right? And oil trades in dollars. So the cost of dollars goes up. So this is a long-term, weekly chart of the DXY, which is the dollar index. And we're going all the way back here to 2009. We have a really strong upsloping trend line where we've gotten support all the way along since 2009. So there's been a lot of talk about dollar devaluation and, the dollar is dead and all these countries are going to start using, the BRICS countries are coming up with another currency that's going to compete against the dollar and all that. That may happen in the future, but for right now, when the price of oil goes up, the price of the dollar goes up because countries need dollars to buy oil because oil is traded in dollars. So we have a spike up in the dollar that corresponds to a spike up in oil prices. And when the dollar goes up, the I fund goes down. And we had a huge move down this week in the I fund. It was down 7%. So if you're looking at this chart of the I fund, what's kind of important to take a look at is we have been in this uptrend in the I fund since July of 2025. And every little pullback we've had has found support at that upsloping trend line, to include this week. So it's absolutely possible that the bottom is in for the I fund, right? Because it looks like we found support at that upsloping trend line, and maybe price continues higher and just keeps going higher from here. Okay, that's a possibility. This is a great place to look at the market and watch really closely. If we get a little recovery rally and it rolls over and closes below that line, and especially if it closes below this low, the I fund is going lower. Okay, but for right now, support at that trend line, right? Every time we've gotten down to that trend line in the past year or so, price has resolved to the upside and we put in higher highs. So this is a time to really watch the I fund. It's not a time to panic. It's a time to watch what happens at that trend line. And this is the I fund versus the dollar, right? So the I fund is in black and the dollar is in blue. When the dollar goes up, the I fund goes down. Okay. When the dollar goes down, the I fund goes up. It's not day for day, but the correlation is really important to understand. So when the dollar is going into 2022, right? The dollar went up, the I fund went down along with the stock funds. And we've had this big move higher in the I fund, right? Since for about the past year, it came on the decline in the dollar. So if the dollar, which now is at that long-term support level, if the dollar rallies, the I fund comes down. Okay, so it's going to be really important to watch. If the dollar, certainly if the dollar takes out that high, the I fund is coming down because the dollar is going up. So we'll see what happens with that trend line on the I fund. Okay, TSP fund direction. So we talk about this chart every week, right? This is a line chart. It's a weekly chart of the S&P 500. It's the black. This is the 20-week moving average line in blue. You got a relative strength indicator and a momentum indicator, which is MACD. And so the big takeaway from this chart is this. Every time price comes down to that 20-week moving average line, it generally finds support there, right? Until it doesn't. When price does not find support at that 20-week moving average line, it tends to roll over. That's when we tend to get significant corrections, okay? So this was the top before COVID. Once price got below that 20-week moving average line, we had that 35% decline in COVID. We had a 25% decline here in 2022, right? And we had this 20 or so percent decline into the April bottom last year. So this week, price closed below that 20-week moving average line. Is it possible that we get support and price turns around and keeps on going higher? Yes, it's possible. But the history, what you're trying to decide in making reallocation decisions, is it more likely that price continues lower? Is the risk higher that your potential upside versus the potential downside, right? It's the risk reward. And you have to take that into account in conjunction with your personal circumstances and risk tolerance to decide whether to stay in the stock funds or to reallocate it to the G fund and see what happens. And so relative strength obviously is rolling over. It's not yet below 50, but it's very close. And MACD is negative. So the risk based on this chart is very high. F fund, really interesting. We've been talking about this here for months. The 100 level has been support and resistance, right? Going all the way back to 2022. And so we are in this long-term sideways consolidation in bonds, okay? In the short term, we had this 10-week support at that 100 level. And then we had a breakout, right? We had a little pause, and then we had a breakout last week. And then the F fund completely rolled over this week. So why would the F fund roll over, right? Countries have, if the price of oil goes up, countries have to sell things to be able to buy oil at a higher price. And one of the things they sell is U.S. Treasuries. And so they sold Treasury bonds and the price of bonds goes down. Okay. So in this case, the F fund, it's not a great alternative to the G fund if you're thinking about reallocating out of the stock funds. Okay. All right. We do a whole lot more in-depth analysis in our newsletters every week for subscribers. So if you like this kind of analysis and you see the value of using technical analysis to support your reallocation decisions, in line with your personal circumstances and risk tolerance, definitely check us out at growmytsp.com. If you guys have questions on anything we talked about in the podcast, you can send questions to support@growmytsp.com or put comments in the podcast, wherever you find this video. Hopefully Conan will be back next week. It certainly can be another very exciting week here coming up. So stay tuned. All right. That's all I got. Have a great week.